I just wanted to go over one thing that we kind of skipped over in the practice problem that we were working on. And I think it's a semi important topic, so I just want to talk about it. Um, it asks you to prepare the liability section for this company as of March 1st. Okay, so uh, why it's asking you to do this is it wants you to differentiate between current and long-term liabilities. Okay, so though both of these loans are multi-year, um, it actually doesn't say. Yeah, okay. We can assume that this is a multi-year. It doesn't actually say when it's due, but we know that this one is it's like a 5-year loan. But on March 1st of the next year, some of that is due within 1 year. Okay, so you have to, for this one, it's quite easy. If you remember back, we had just this straight loan here. And so after the first, uh, actually, let's see, this is on March 1st, we make the payment. And so we're basically at the second line here. Okay. So of this, let's see, I don't want to mislead you here. Yeah, see, the book is a little inconsistent. Okay. Because what it is asking you to do is, uh, okay, actually, no, sorry, I'm wrong. Okay, so this is the March 1st of the next year payment. This is your first payment is this first line here. So after the first payment, your total loan balance is 80,000. Do we agree with that? How much is due of that principal in the next 1 year after that first payment? When is the next payment date? This is March 1st. This is also March 1st, but of the next year, right? So how much of this 80,000 is due within 1 year? 20,000, exactly. And then how much is due more than a year? 60,000. Okay, so on the balance sheet for this first one, this first note payable, we're going to have current liabilities, note payable, and then we'll have a long-term liabilities, note payable. This is going to be 20,000 as we just discussed, and this is going to be 60,000. It's the same note, right? Total 80,000, but we've now just divided up between the current portion and the long-term portion. So is everyone good with that? Pretty straightforward. It's a little more complicated with this mortgage, okay? Um, it's again going to assume, remember, we have January 1st, February 1st, March 1st. It's going to assume when we do the balance sheet date as of March 1st that we make this payment, okay? So we're basically going to have uh, these next 12 payments are going to be current. They're for the next upcoming year. So you would have to, because remember, on the balance sheet, we're not worrying about the interest expense. We're just talking about how much principal, how much of the mortgage payable we have to pay off. Okay, so we're just going to look at the principal that we're going to pay down. Okay, what principal is due within the next year? So if you add up these 12, it's $71,460. Okay, so I can show you this sum. And I make sure there's 12, right? Because in the next 1 year, we have 12 payments due. Okay, so this is going to be the current portion. So again, I'd go down to this mortgage payable. Is equal to this sum. And then the easy way to get how much long term is I could just look after we make this last payment, this number 15 here, it's going to be this is the balance due, right? That's going to be how much principal is left to pay off in all the remaining years. Okay? So this is what it would look like. Okay? Is everyone good with where I got these numbers from? So again, this making the payment schedule will be helpful for you to answer this question of how to split current and long term, especially for the mortgage. Okay? And again, the way I got this is, again, these are the next 12 payments. So I know that of this balance that I have, that this amount of principal is getting paid off within a year. And at the end of the year of this next 12 months, this would be my balance of principal that is going to be remaining for the whole rest of the loan. So that's like the long-term portion. Okay, everyone good with that? Okay. All right, so let's move on. I think since we have limited time, what I'm going to do is just go through the lecture, and then we'll just work on the practice problems at the end of class until we end. Okay, so try to pay attention, retain kind of what I'm doing. I'm gonna have to go a little fast because again, there's a lot in this chapter. So I just want to make sure we at least get through the lecture of everything, and then we can spend the rest of the time with the practice problems. Okay, so again, a bond. Okay, I think actually what might be better is to explain a little bit about. We talked about yield and price, right? These are two related items. Okay, so I have 3 sample bonds here. Okay, and ignore this for now. Look at this. This is first year, second year, third year, all the way down to 10. So this is a 2-year bond. Okay, it's paying 2 years. It's in the first year, it makes an interest-only payment of $100. So our coupon rate is 10%. Do we agree? Because in the second year, you're getting the 10% interest plus the $1,000 of principal. So $1,000 of principal times 10% is what? $100. Do we agree? Yes. This is the same coupon, but now this is a 6-year loan. This is the same, except it's a 10-year loan. So in each of 3 of these cases, the total principal is 1,000 and the coupon rate is 10%. And so this schedule of payments is fixed for all 3 of these options. This is not going to change. The bond issuer at the onset is saying, here is the payment schedule. Here's what you're going to expect as an investor to earn. Okay, so if you added up the totals, you can see that this 2-year bond, you're going to make $1,200 total if everything goes right and the bond issuer pays everything. $1,600 and $2,000. So you may be like, okay, well, I'm making $2,000 with the third one. What is the trade-off though? What are you trading for that extra money? Time. Exactly. It's going to take, this is going to be, you're going to get your $1,000 of principal back in 2 years. In this one, it's going to take you 10 years. Yes, you're earning interest every other year, or you're getting a coupon payment, but you have to wait 10 years for you to get your principal back. So yes, you're going to earn more, but you're taking more. It's going to take more time and more risk because in 10 years, whoever issued this bond, things could go badly for that. Okay, so you're going to earn more, but you're taking more risk, and you're kind of so you would expect a higher rate of return for that, right? Okay, so now let's look at what this is calculating. Okay, so it's using this function NPV. At the end of the lecture, I'll talk about the details of this, but what it's doing is that it's assessing, okay, what is $100 in 1 year worth to me? What is $1,100 in 2 years worth to me? Okay, and it's then using that formula for present value to calculate in the present moment, what are these 2 future cash flows worth? Okay, and the reason why it's exactly 1,000 right now is because the discount rate, meaning the market rate of return, is the same as the coupon rate. Because remember, this is paying a 10% coupon. I'm also using a 10% discount rate to figure out the present value. If I change this, let's say the market is like requires an 8% return, right? You can see that this number changed. Okay, why is it now above 1,000? Well, it's because though I'm paying uh, a 10% coupon every year, the market is like, actually, I'm okay with making a little less than that. Okay, so they're willing to pay more than the principal amount that they're going to get back at the end as kind of like a hit to the interest that they're going to take. Okay, you can think about it like that. So remember, if you if the market yield was the same as the coupon, they're going to pay $1,000 and they're going to get $1,200 back if this all goes well. If the market yield is 8%, they're going to actually pay $1,036. This $1,200 is unchanged, right? Because this payment schedule is fixed amount. But now the investors are willing to pay a little more, right? And earn a little less money because this $1,200 is how much they're going to get back total. But now instead of paying 1,000, they're paying 1,036. Yeah, 1,036. So that makes sense how this increase in the price, and you can see the price here is a percentage of the par value. The par value is 1,000. The bond is now priced at 1,036. So it's now a little above 100%. So investors are willing to pay a little more than the par value because they're willing to accept a little less return. Does that make sense? Okay, so what if investors like, okay, actually 10% is not enough. I need a 12% return. So you can see the par value, the price of the bond is now below 100, meaning that, again, this $1,200 is fixed, but now the investors are only going to pay $966. So they're going to earn a little more than, if they had paid par, if they had paid 1,000, because they now require extra return because, this discount rate is kind of a fluctuating thing that changes based on various things. Okay, this is one of the most watched financial metrics in the world is our interest rates. Okay, and they're constantly changing, and they're based on inflation, the risk of the issuer, what the risk-free rate is, meaning the government rate of return. So there's many things that affect this interest rate, and it's constantly changing. Therefore, the price of the bond is constantly changing. Okay, but let's do one experiment here. Let's just make all of these 8%. Okay, so you can see here that when I did that, why is this price it moved much more, right? I just changed all of the yields from 10% to 2%, but you can see that this 10-year bond, the price changed much more than the 2-year bond. And this is a function of that formula that I told you. Future value equals present value times 1 plus r to the t power. Because there's an exponential in there, the longer the term of the bond, the more sensitive it is to fluctuations in interest rate. Okay, because it's like compounding. It's a compounded rate of return. So the more periods there are, the change in interest rates are going to affect the price much more. Okay, so these are the two things to keep in mind. This is complicated. Again, people that work in finance, this is like their whole life. If you choose to go down that field, you will hopefully develop a very strong intuition of how these numbers work. That's like a big part of like being a bond investor. Like if are like working with bonds, or working with discounted cash flow. I think at the end of the lecture, I'll show you how this framework is used in various contexts. Okay, but it's all based on this time value of money calculation, and the further out a cash flow is, this cash flow that's 10 years away, it's much more sensitive to the change in interest, the discount rate you use, because there's a compounding effect. Yeah.
Can you show what your NPV function takes in?
All it's taking in is the discount rate, this first one, which is orange, and then all the cash flows.
And all the range?
Yeah, so I'll just do the function for you. Okay, so NPV. First one it's asking for is a discount rate. So then I just point it to this. And then the next one are all the cash flows. So then I just go like this and I hold shift and just highlight all of them.
Until the line raw 16.
Yes.
50.
I mean, you could do it like for this one, it's going all the way to the bottom, but the last cash flows is here. Yeah. Okay. Okay. So, look, these prices are these two are related. Okay. The yield and the price are different ways of saying the same thing. Okay. So, um, this website, it tracks the trading of major issuers of bonds. Okay. So you can see here, if we just look at one, this is Budweiser. Okay. This bond, let's look at this. So this is issued by Anheuser-Busch. It has a coupon rate of 7.55%. So again, we could, the maturity date is 2030. So we could go through and with a hypothetical $1,000 bond, make all the cash flows to 2030. Okay, because it's going to be paying this 7.5% of a thousand. Let's just say the bond that you bought was $1,000 increment. It's going to pay you $7.55 per year until 2030. So that schedule of payments is a fixed thing. However, you can see that the market yield is 4.41%. And because this yield is lower than the coupon rate, it's trading at a premium. So it's essentially what we were just doing here. The coupon rate is 10%. The market yield is lower than that at 8%. And that resulted in a premium. Okay. So there's a function in Excel that can actually do the same calculation. So let's just do it for this bond issuance. Okay. So you can understand the different parameters. Okay. So this bond traded at, let's see, when did it trade? 420. Okay. So 420, 2026. So the issuance date or the trade date. This is going to be the date that you're starting the investment. So 420, 2026. Maturity date it said was 2030. So 10/1/2030. The coupon rate is 7.55%. The frequency, this detail is not given here. This is the frequency of payment. Is it annual, semi-annual, quarterly? It doesn't make that big of a difference. So I'm just going to put 4, which means quarterly. And then there's two ways we can do this. Again, if you're given, sometimes bonds are only quoted with the market price. And if you wanted to find what the yield was for that, there's a function. Okay, so let's just put in the price here. The price was 112.51. Okay, so now you can use this function called yield. And the terms are the settlement date, meaning the trading date, the maturity, the coupon rate, which is 7.55%, the price, which is this market price, and then the redemption, meaning what is the par value. Okay, so it's going to most often be 100. Okay, there's some bonds that are callable, meaning the issuer before the maturity date can pay extra, like 110, some extra amount to entice investors. Uh, they're actually legally able to do this, but they're going to pay sometimes a premium. Okay, but in this case, it's going to be maturing at par, and then frequency. We'll just put 4, and so it gives us this calculation. So let's just see if this lines up with what it says in this page. So 4.43%, 4.41. There's probably some little difference. Maybe there's payment frequency or something, but it's pretty much the same. So if we were given this price, we can then figure out what this yield is. And the other way around, if we did it, if we're given the market yield, okay, 4.41, we can then use the function price, and it's kind of the same terms. remember the coupon is fixed, right? That's why it's the same in both these calculations. It's just part of that payment schedule. Okay, so you can see that it's a little off. There's probably some little detail in the math that makes it a little different, but they are related. Okay, these two things. I don't know. Let's see. Let's try to change it to this. No, yeah, I'm not sure. We'd have to. Oh, sorry. Oh, 441. That's why. Okay, so you can see here that um, the price and the yield are synonymous. Okay, you can if you know everything except for one, you can calculate the other. Okay. Um, so any questions on this? Again, this is like an advanced topic, I would say. Um, but I think the thing to remember is that price of the bond can be above or below par, and that will depend on what the market yield is in relation to the coupon. Okay. So with that in mind, let's like now go and look at some of the accounting topics related to this. So when bonds are issued at a discount, the company is going to receive less cash than the par value. Okay, so again, if we look at the case where it's trading at a discount, right? This is the price of 96.62. At the end of 2 years, you're going to pay $1,000 of principal. Right now, you're only going to get 966. Okay, so you're going to end up paying not only the coupon rate of 10%, you're going to pay an extra amount at the end because you're only getting $966 up front. Does everyone understand that? This is the this is like what happens when you're issuing or selling a bond at a discount. Okay, and really, it's at the time of issuance, this money is going to the company who's issuing the bond. After it's trading in the market between different parties, the company doesn't really care because they've already received whatever discount or premium happened at the issuance. After that, it's like between the investors as to who's taking the loss or whatever. Okay, but we're assuming that this is happening at issuance, that you issue the bond at a discount. Okay, so the company is going to receive less cash. Okay, and so an example: if you issue a $135 million par value bond at 98, okay, the company is only going to receive this much money, 132.3 million. They're going to have a liability for 135 million though. Okay. So we'll have to figure out a way to account for this discrepancy between the cash received and that liability, that par value that they're going to pay at the end. Okay, we have to figure out a way to do that. So you can think about it that this extra 2.7 million that they're paying on the back end, because again, they received 2.7 million less, it's like extra interest. Okay, not only are they going to pay the coupon every month, this extra amount it's like the gap between the par value and what they received, that's going to be an extra amount they're going to have to pay as interest. Okay, so opposite is true when you issue at a premium. You're actually going to get more cash up front than you're going to pay on the back end. And so, an example, if we have a $250 million par value bond issued at 103, and see we're going to get more money. Okay, we're getting 257 million, but we're only going to pay back 250 million at the end of the bond. So that extra 7.5 million is like, though we're paying that coupon, we're actually like paying a little less because we got extra money up front. Okay, so it's like reducing the interest cost. Okay, so this discount or premium, the way that we're going to now deal with that is to amortize it straight line over the life of the bond. Okay, so we'll see how to do that in a second. We're going to have, in the case of a discount, a bond that's issued at a discount, a contra account called discount on bonds payable. Okay, so this is going to be a debit balance. Our bond payable is going to be a credit balance And offsetting that will be this discount on bond payable contra account. Okay. If we issue at a premium, again, the bond payable is always going to be, in this case, 250 million. If you issue it at a premium, you're going to have an adjunct liability account. So what does that mean? It's going to be called premium. So unlike a contra account that has a debit balance, this is also going to have a credit balance. They're both going to have credit balances. These both go together, bond payable and premium on bond payable. They're going to be together, but they're both going to have credit balances. Okay, so we'll see why that is when we start doing the actual journal entries. But it's called an adjunct account. Okay, meaning that it's not it's not an opposite balance. It's the same normal balance as the account it's like buddies with. Okay, so let's look at examples here. So in this case, the company issues a bond at a discount. The face value of the bond is 120 million. Okay. It pays a 5% coupon. So just based on this information, and okay, in 7 years, and it's semi-annual. Okay. So just based on this information, I can make the whole schedule of what this bond is expected to pay. Right. So 5% of, let's just do some math here. So if I did 5% times 120 million is 6 million, and it's semi-annual. So let's just say we have payment every January and July. So Jan 26, we'll have 3 million, 3 million on July 26, and then on Jan 27 and July 27, 3 million, 3 million. And then this goes all the way for 7 years. So we'll get to, eventually we'll get to July, what is it, 33, and it'll be basically 123 million, because you'll pay the 120 million plus the 3 million of interest for that payment period. Okay, so you can make the whole payment schedule, dates and everything based on this. Okay, so this is again a fixed schedule. Now, this fixed schedule is going to now be like, you're going to go to investors and be like, here's what I'm offering. Here's the payment schedule that I'm offering to you. How much are you willing to pay for it right now? Okay. And they may not pay 120 million. It's going to price. The bonds will price at a certain yield, right? If it prices at exactly 5%, then it will price exactly at 120 million. But that's not the case. You can see here that the bonds are priced at 97. So does that mean the market is demanding more or less than 5%? If you're issuing it at a discount, are investors happy with the 5% coupon, or are they expecting a little more return or a little less return? A little more. Okay. So this is maybe priced at it's 5.3% yield. Okay. So that's what that discount is representing, that the pricing of the bond is at a discount, meaning the investors are requiring a higher rate of return than the coupon is going to compensate them for. So they're not going to pay par value. They're going to pay a little less. Okay. So there's now several questions. Number one, what is the journal entry at the time of issuance? Okay. So we know that the bond is issued at 97. So what does that mean in terms of how much cash the company is receiving? Second topic would be the semi-annual payment. Okay. It's going to be the same for every payment, because again, it's just paying this semi-annual coupon every time. Okay. And then the last one is the maturity. Okay. So I'm just going to talk through it. We're going to talk through it, and then, eventually you're going to get practice with it. But I think just try to follow along. Okay. So at the time of issuance, basically you're going to have to deal with cash coming in. you're going to have to deal with the fact that it's less than the par value. You're going to have to record some bond payable at the par value plus the discount. Okay, so if we look at how this is going to work, you can see it here. Okay, so how did I get 116.4 million? Well, we know that the bond's priced at 97. We know the par value is 120 million. So what's 97% of 120 million? What do you think it is? It is 116.4 million. Okay, so the bond investors are only going to pay 97 cents on the dollar. Okay, so they're only going to give this much cash to the company. Bond payable, remember at the end, at maturity, you're going to pay 120 million of bonds. So you have to record this liability at 120 million. To close the gap, we're going to have this contra account set up called discount on bonds payable. Okay, so you basically are going to have this set up. Okay, you have bonds payable, right? This liability, that's the par value. We have the cash that came in, and we have this discount. On the balance sheet, you're going to report the bonds payable as the net of the contra and the bonds payable. Okay, because again, these two are buddies. So it's like showing when you work with receivables, the accounts receivable less allowance for bad debt. It's like similar to that. Okay. Okay. Any questions on this so far? No. Okay. So the next thing is when we pay our interest. Okay. So we basically have to figure out, because eventually this discount, it's going to get eaten up over time, because at the end of the life of the bond, this is going to converge to 120 million. Okay, because that's how much the liability is going to eventually have to equal how much we're actually going to pay off, right? So this bond payable is going to get eaten up, and it's eventually going to go to zero. Okay, and the way that we're going to eat it up is to basically split it straight line over every payment. So if this is a 7-year bond and it's paying semi-annually, how many terms what do we need to divide this discount on bond's premium by if we're going to split it up evenly over every payment? How many payments total are there? 14. Exactly, right? 7 years, 2 payments per year. 7 times 2 is 14. So what we need to do is divide this by 14, and we'll get how much at each payment we're going to amortize it by. It's just like straight line depreciation. It's the same calculation. Okay, so you can see here that we have the amount of cash going out is fixed. I already showed you up here. Where is that? Oh, I deleted it. But I made that payment schedule, right? We knew that every payment date is paying $3 million. This is determined by the coupon, right? Which was 5%. So at the outset of this issuance, we knew that this is the amount of cash we're going to pay out as part of this bond. The interest expense, though, is more, because not only is this the cash coupon expense, we're also amortizing this bond payable. Because remember, we didn't receive the full amount up front, and we're splitting that deficiency evenly over the life of the bond. So that's going to raise our interest expense.
Is it per year or per
This is per payment.
payment? Then is it, you should say 5 or 25?
We should say what?
How many percent there? You still say 5%, even though it's semi-annual?
Well, this 5% of 120 million is 6 million. So this is
the coupon
5%.
5%.
Yeah.
So place semi-annual, you still identify it as 5%. You don't divide it.
So 120 million times 5% equals 6 million. And so if you're paying semi-annually, that's $3 million per payment.
Right.
Yep.
So you still say it's 5% when you have it semi-annually, right? You don't say it, how many percent actually, because it's not 6 million, it's twice less. You don't say 2.5%. You still say
Yeah. Whenever you speak of yields and interest rates, you always annualize it. So you can say that if you multiply this by 2, because again, that's like kind of our yearly interest expense. So 3,257,143 times 2, 6.514% divided by 120 million. It's 5.4%. It's kind of the actual, if we use this straight line method, your actual interest expense is 5.4% because it's not only the 5% coupon, but this amortization of the discount.
okay,
Make sense?
yes.
Okay. Okay, so you can see here after this one payment, we have, and again, where did this come from? This is this 3.6 million divided by our 14 payments. Okay, so you can see here that we have this discount on bond payable. This is a debit, so it's reducing this by an incremental amount. This is unchanged. Our interest expense is here, and of course, cash is being paid out. Okay. Now, again, the bond payable now is, you can see, going up a little bit. Okay, it was 16.4. It's 16.7 now. And over the life of the bond, it's going to converge to 120. It's going to start low, and then as we kind of eat up the discount on bonds payable, where as we amortize it, it's going to slowly creep up to 120 million. Okay, so now at maturity. Okay, so let's do the journal entry. We're going to pay off the bond, right? That's the whole point. So we're going to get rid of that liability to debit. Really, the interest expense is the same. It's the last interest payment. So we are going to still have the interest expense and the discount on bond payable. It's kind of gonna kind of be the last one of these. And then, of course, cash is going to be the last coupon of semi-annual interest plus the 120 million of principal, the par value. Okay, so if we look at the T accounts, again, you can see all these three, all the interest payments that were semi-annual. There's a bunch of them, 14 of them total. Interest expense. This is just for 1 year. Okay, this is just 1 year of interest. Every year is going to have their own interest over that 7 years. Discount on bonds payable. There's 14 of these. Okay, one for every payment. So this goes to 0. This goes to 0. Okay, this one is the last one that came from here. Okay, is everyone good with this concept? Yeah.
Can you go back up a little bit?
Yeah.
So the 3.6 million, what part of the problem is that?
That's from here when we issued the bond. Okay, so when we issued the bond, remember we priced it at 97, right? So 97 times 120 million is only going to give us 116.4 million. The gap is going to be this discount on bonds payable. Yeah? Okay. Okay, so now let's do the opposite case where we issue at a premium. Okay, so the face value of the bond is 82 million. Okay, here it pays an 8% coupon, semi-annual interest-only payments, and it's a 5-year maturity. Okay, so we can see here that we issued these at a premium, higher than par. Okay, so at the time of issuance, you can see that we're receiving more cash than the bonds payable. So we're going to have cash coming in that's higher. And so to make the journal entry work, it'll be easy to figure out whether it's going to be like a contra account or adjunct account, because when you first issue the bond. As long as you understand how the bond price is related to how much cash is coming in. Okay, that's the key thing to keep in mind. If you know that, then if it's at a premium, you'll know that the cash is coming in more than the face value of the bond. And to plug the journal entry, you're going to have an extra credit. Okay, so you'll be able to determine it quite easily if you conceptually understand what's happening. Okay, so now we have, again, credit balance here and a credit balance here. So this is an adjunct account. Okay, the discount was a debit balance, right? This is a credit balance. Now, you can see here that the bond payable is going to be recorded higher, right? We're adding these two up, these two credit balances. So in the balance sheet, it's going to be above this, but this is going to actually go down because we're going to basically amortize this 4.1 million with debits, and it's going to go to 0 too. So this will actually converge down to 82 over time. So if we have semi-annual interest payments, it's a 5-year bond. How many payments are we going to amortize this over? What should we divide it by to get the per payment amortization? Semi-annual, and it's 5 years. 10, right? 5 years times 2 payments per year. What if we had quarterly? What would we do? 20. 4 payments per year, same 5 years. If it was 1 payment per year, you would just divide it by 5. You'd only be making 5 payments total. So you just have to remember that it's divided per payment. Okay? Okay, so then when we made our interest payment, you can see here that where is this coming from? Well, it's 82 million times, what was the coupon rate? 8%, right? Because look, face value of the bond is 82 million. It pays the 8% coupon. It has semi-annual interest payments. Okay, so we're going to multiply 82 million, the face value, times 8%, and then we can divide this by 2 to get the semi-annual interest, the amount of cash we pay for the coupon. So let's just make sure I did the math right. 82 million times 8% divided by 2 is exactly 3.28 million. So this is the calculation. So is everyone good with this? Okay, so now we need to figure out how much expense we need. So again, this divided by 10 gives us 410K per payment. That's where this is coming from. And the interest expense is just going to kind of be the plug to get the journal entry to balance. Okay, and you can see here the interest expense is much lower than the actual cash going out. And it's because we received more cash up front. And so we're kind of spreading that extra bounty over the life of the bond by reducing the interest expense. Okay, so you can think of it that this extra 4.1 million that you got up front, it's kind of like part of, you're giving some of it back here in this coupon payment and reducing your interest expense. Okay, so again, if you look at the balances, this goes a little lower. Your bond payable goes down a little bit from 86.1 to 85.7, and this will eventually again converge to 82 million. Interest expense, cash, it's the same, except remember for this, for the discount, it started off as a debit balance and you're crediting it. This is starting off as a crediting balance and you're debiting it to amortize it. Okay, and then finally, when we pay the bond off, this is going to go to 0. So this is check. This last one is going here. The cash is going to be, again, for the last coupon, which was, what was it, 3.28 million. So this is equal to 3.28 million plus par value, 82 million. and then the interest expense for that last payment. Okay, everyone good with this? Okay. All right. So we'll come back to the practice problems. We'll let you practice with this, but I would just want to finish everything so that we don't miss any of the lecture content. Okay. So accounting for the retirement of bonds. Okay. So all this stuff has been I guess we kind of did it talking about the maturity, but let's just make sure we're clear on how to do this. Um, just some extra detail on bonds. Okay. There are these things called callable bonds where the company has the right but not the obligation to retire the bonds before maturity for a pre-specified price. So it may be like, okay, the official maturity is 2030, but the bonds are callable in 2027 for a price of 110. This is an example. Okay, so if it was advantageous for the company to retire the bonds early, then they are telling the investors we have the right to do that at this price. Okay, they don't have to do it, but they have the right to, and these are callable bonds. Okay, so oftentimes the bonds that are callable, they're priced to assume that they're going to be called. So this is kind of a technical detail, but just it's kind of you may see this in the business world. They're very common. Bonds have a call date. Okay. Issuers can also retire their bonds by just going to the open market and just buying them. Okay. So if you feel like your bonds are trading at a discount unfairly and you have the cash as a business, let's say the bonds are trading at 50 cents on the dollar, and so 50%, let's say you had 120 million of bonds outstanding. If you could buy them for 60 million and just retire them, you're getting a windfall of 60 million because this liability where you'd have to pay $120 million back, you're able to retire them for 60 million. This is rare because if you have $60 million on your balance sheet, you're probably not in distress, so it's not probably super common, but it's possible. Maybe during periods of like financial distress, when the bond markets are in turmoil, just in general, if a company is really strong and has a strong balance sheet, they may choose to do this just because all bonds are depressed. They may find a good deal on their own. Okay. The reason why a issuer would want to retire a bond early is either to clean up their balance sheet, meaning they lower how much liabilities they have, or they want to refinance. Maybe they have a bond that has a really high coupon, and they just want to lower that cash outflow by reissuing bonds. They could do that. So there's various cases where a bond issuer may want to retire the bonds early. Okay, so what you need to do if you want to retire the bonds before maturity, you have to record whatever amortization for the discount or premium on the bond discount or premium, like whatever portion at the time of retirement. Because remember, we're doing this in a straight line basis, right? And we're only doing this during payment periods or payments. So if you're retiring a bond early, it's going to be in between payments. So you have to basically figure out what portion of discount or premium on bond payable that you need to bring it up to that date you're retiring it. Then it's kind of like how we got rid of plant assets. Okay, you're going to remove the unamortized discount or premium. You're going to debit bonds payable at the face value. So again, we have bonds payable. Let's say it was 120 million. Discount. Maybe we started with 10 million, and maybe we were amortizing 1 million every year. And now you're retiring it, and maybe the partial year was 0.2 million. So the total is, what is this? 8.28, 7.8. So you will basically debit this, credit this, okay, to get rid of them. And then you'll see how much cash you paid for the bond, and you'll see whether you had a gain or loss. So it's very similar to how we dealt with plant assets, disposing of them. Okay, so let's just look at an example. So we issued a 10-year bond. Par value is 87 million. And this was in 2000. So it's supposed to mature in 2030, but partially through in 2025, we decide we want to retire the bonds at a price of 98. On that day, the total remaining premium balance is 870,000. So we basically, we had some amount we were amortizing for premium. We brought it up to date, and the balance is 870K. That's the situation that this is stating here. And again, the bond payable is 87 million. Okay, so now we want to retire it at 98. So what is the calculation for how much cash we're going to put up if we're paying 98 cents on the dollar? Is it 98 times what? Any ideas? Yeah, Mohammed. Yes. The pricing is always on par value. This is par value. Okay. So whenever you see a price, the calculation is not going to be based on this net. It's going to be based on the par value. Okay. So it would be 87 million times 98%. That's how much cash your company's putting out to retire the bonds. Okay. So if you look, so again, this is going to be 98% times 87 million. That's how we got to that amount. Bonds payable, we're debiting. Premium on bonds payable, we're also debiting because this is an adjunct account. And so when you fill in all these, you'll see that there's some gap in the journal entry. You need to fill it. And if it's a credit, it's going to be a gain. And if it was a debit, it would have been a loss. Okay, makes sense? So very similar to chapter 9, what we were doing. Okay. Again, we'll do a practice problem but after we finish this. Okay, this is probably the most important part of the chapter. It's not really like on your homework or anything, but conceptually, understanding why a company would even issue debt in the first place, because you're paying interest on it, right? So why would you ever do it? Why not just sell stock? You don't have to pay interest on stock, right? So this is what corporate finance, this is what a CFO is doing. Okay, the trade-off between debt versus equity financing. Okay, so let's talk about. Does anyone have an answer to this? Why would a company ever borrow money if they're paying interest? What do you think? Yeah, there is a tax advantage with borrowing in that interest is tax deductible, but you're still paying interest. Yeah. Okay, yeah, that's one reason. But you could just issue stock too. Well, if I needed the money, I could just go to the stock market or call Goldman Sachs and be like, "Hey, I want to issue shares to raise the money." No, the company can also always sell more shares, right? It's like the first journal entry we ever did was company issues common stock for cash, right? So I could just do more of that and raise more cash. Yeah, Chris, what do you think?
The expectation that the interest rates go up.
Yeah, but I can avoid paying interest altogether. Yeah. Yeah.
The shareholders not gonna have the same interest paid to them, but I mean dividends, right? Compared to when the company takes debt on.
Okay, you're getting to the idea. When you issue more shares, you're splitting the pie of profit among more people. So if you have a pizza, if you only have four people, you can cut it into fourths and you get a pretty big slice. If you now add four more people, you have to cut those into 8 pieces and you're getting a smaller slice, right? So one hope when companies do issue stock is that the entire pizza will grow bigger. So that though you're having more people, the size of the pizza, you're going from a small to an extra large. You'll have a smaller, there will be more people to share with, but the pizza size is larger. So your slice is actually going to be better off. Okay, so that's one thought. Or you could just borrow and not split the pizza with anyone, but you're going to have to a fixed cost. Like maybe out of the pizza, you have to give some amount away, but then the rest of it, everyone splits evenly. Okay, so let's just look at an example. Okay, um, okay, actually, let's just go through this systematically. Okay, so borrowing is usually a cheaper source of capital. Now, it doesn't seem like common stock is uh, paying a interest or there's like an actual fixed cost to it, but there's an implied cost because your business has a certain earnings per share. Okay, and oftentimes uh, the company you can get a yield from that. So let's say your company earns $2 per share. Okay, if you're issuing shares for $5 each, then it's a quite high cost. It's like 40%. Okay, you're having to share $2 of earnings, and you're only getting $5 back. So you're actually selling the earnings for very little. Like a company like Nvidia, the reason why they issue shares like crazy is because let's say they have $2 per share, and their shares are selling for like $200. Okay, so they're paying like 1% or less, you can say, in kind of earnings yield. Okay, that's why they're willing to issue way more shares because actually it's quite a cheap source of capital for them because the stock is so highly valued. But that's not always the case. And if you looked at Nvidia, they probably borrow very little because their stock is the investors in Nvidia are willing to give them so much money for so little return in terms of earnings. Okay, but that's not the case. Nvidia is kind of like an outlier. There's such a huge bubble around it that they're able to do this. Okay, so oftentimes, CEOs are incentivized to get a lot of hype in their stock because it becomes currency. It's valuable currency to acquire other businesses, to do other things. It's a very cheap source of capital. The investors, of course, are probably going to get screwed because they're giving their money for very little in return. But it is what it is. But again, the median company uh, equity tends to be a expensive source of capital. Okay, so they're able to borrow for cheaper. So, um, so again, the way that you can see this also is through dilution. Okay, so when you issue new shares, the profit will be split between more people, and oftentimes that raising a certain amount of money by dilution is going to be worse off for the existing shareholders than borrowing. Okay, but there is a cost. If you borrow money and things go badly, you can get wiped out more easily. You're more susceptible to bankruptcy and like going out of business by borrowing because the lender doesn't care if your sales are down a little bit or down a lot or there's some turmoil. They want their interest payment. Okay, they're trading a higher return for that certainty that they're going to get their payment. So if you don't pay them, then they're gonna do bad things to your company. Okay, put you out of business and take whatever assets are there. Okay. Okay, so I think the best way to illustrate this is with a little example here. Um, so plan one. So the idea is you want to raise $500,000 for some new project in your business. Okay, so you have two plans. Plan one is to issue a bond that pays 10% interest. Okay, plan two is that you can issue common stock at $10 a share to raise the 500,000. So how many shares will you be issuing based on this? 50,000, right? 50,000 shares times $10 a share. That will give you your $500,000. Okay, makes sense? But now you have 50,000 more slices of your pizza pie. Okay, so let's look at the numbers. So your pre-existing before this new project is 300K in both cases. For just this project, okay, this incremental $500,000 project, this is what it looks like. You're gonna have this much operating income, right? So the revenues minus the operating expenses. It's the same, right? You're investing in the same new project in both cases. You're just deciding how to finance it. Okay, so this is again related to our assets equals liabilities plus equity. This 200K is just related to how much that 500K asset is going to generate profit. Okay, now we're going to think about the difference in this financing decision. So in the case of the bond, we're going to have this interest. In this case of the stock, we have no interest. So you can see that our pre-tax profit is lower by issuing the bond than it is with the stock issuance. So at this point, if you're like, like a first order thinker, you're like, oh, well, obviously I should issue the stock because it's more profitable. Okay, so let's keep going. Your income tax is going to be based on this pre-tax profit. So you can see that you have slightly lower income tax expense with the bond because the interest is tax deductible. And so this lower profit is going to result in a lower tax bill. Okay, but you can still see it's not enough to offset. Okay, you're still making more net income with the issuance of stock by gross dollars. Okay, so again, your first order thinking brain would be like, well, I'm making more dollars if I just issue the shares. Okay, but that's not the full story. So now if we look at the total profit, which is the pre-existing profit plus the new profit from this project with the two different financing strategies, you can see that it's lower for the bond issuance because again, we had that interest expense. Now though, this is where the big kicker is. In the original case, we started off with 100,000 shares. We just decided here to raise this that we needed to issue 50K more shares. So in this second case, we have 150,000 shares. So when you do the earnings per share, you can see that it's higher for the plan where we had the bond issuance. So the existing shareholders, they're getting more bang for their buck by borrowing money rather than splitting up more profit, but with way more people. Okay. Now, let's say instead that our shares, instead of $10 a share, were $100 a share. Okay. How does that change? This is what I'm saying with NVIDIA. So to raise this 500K, instead of issuing 50,000 shares, we only have to issue how many?
5,000.
5,000, exactly. So
Isn't that like spent to one thing? What's it called? When a company like has like 10 times less jobs, but you're worth more.
they're 10 times what? Sorry, I missed that.
Never. If that comes to a stock term.
If you think about it, let me know. But let's just do this last calculation. So now if we only had 105 shares, because again, we just did a hypothetical where we changed this to $100 per share. Now, 450,000 divided by 105,000 is 4.5 28 or 29. Okay. So yes, in that case, if you can issue your shares for that price, you're better off issuing the shares than borrowing from the bond. But then, if you change the bond to 5%, that could change things. So this is what a CFO is doing. This is their whole job, is to make this kind of analysis. Okay, they're deciding the split between the cost of capital between issuing stock versus bonds. How much risk should they even take? Because it can always be better to issue bonds, but at some point you're going to be over levered and it's going to be dangerous for your company, right? So the CFO's job is these types of decisions. Okay, they're not so concerned about the operations of the business. That's the COO or the the CEO's kind of responsibility. They're more concerned about that. The CFO is concerned more about these types of decision making. Yeah.
Called reverse stock split.
Reverse stock split, where they, yeah, but it's
Where they like have 10 stocks and maybe talk one.
okay. It's a different thing. In the next chapter, we're going to talk about stock splits.
Uh,
There's actually no exchange of money that happens in a stock split.
um,
Okay.
I know what they like. No, I know it's like when we get $100 by stock split.
Yeah. Exactly. But there's no exchange of money. It's just like going from, as you said, $10 per share, and there's 100 shares, to and you're saying it's reverse. So one share, $1 per share, but now there's 1,000 shares. Okay, so it's the same. The total is still the same, right?
Yes.
So it's just like a lot of companies do stock splits because the stock goes too high for retail investors. Like Tesla has done this several times, where it's like $500, and they'll split the stock so that it goes from 500 to like 100 if they did a 5-for-1, right? So then, unfortunately, there are a lot of unsophisticated investors out there that will be like, "Oh my God, Tesla was $500 and now it's 100." They'll be like, "It's such a good deal." And they'll buy it, right? And people, this is a consistent thing. People will do it, not realizing that nothing's actually changed. It's just there's the stock price went down by 5, but the number of shares went up by 5. So there's no, but they fool their investor base every time they do this, because the investor base is full of unsophisticated people, unfortunately. But yeah, there's no difference. There's no exchange of money.
When
Yeah, Richard.
would you
Yes, I think that could be the case. Like Berkshire Hathaway, the Series A shares are like $500,000 that they never split, but they issued a new series that's at a lower price. Um, but yeah, I think oftentimes it's done to manipulate the investor base. Yeah,
Well, they increase price for
it
increases.
it's free money for them because it always goes up, at least in Tesla's case, by more than the split. Like it goes from 500, it drops to 100, and then it goes to like 150. So they got free money from just doing a simple, like, no value add kind of thing.
We're buying it.
Yeah, yeah, exactly. It's clever. I agree. I'm not going to hate, but it's like I just feel bad for the people that don't know, don't understand. Okay, and then debt to equity ratio, um, the relationship between total liabilities and total equity is called the debt to equity ratio. Um, we had the debt ratio already that we talked about, right? Which is equal to, so the debt ratio is equal to your total liabilities divided by total assets. Now, the debt to equity ratio is related. So DE ratio is equal to your, basically your L divided by E. Okay, but these are all related. You can get, like, if you took your debt ratio, this is equal to liabilities plus equity. You could go between the two. You could substitute. You could solve for L over E. There's a way to manipulate these two to get the debt to equity ratio as a function of the debt ratio. Okay, I'm not going to do it. I'd have to think about it a little bit, but they're related because all three of these assets, liability, and equity are all related through a common equation. Okay, so the information that you get from the debt ratio, it's the same information that you get from the debt to equity ratio, just stated in a different way. Okay, so some people, like for example, if your assets were 100 and your liabilities were 50, your equity was 50. Or actually, let's make this a little 40 and 60. Your debt to equity ratio is equal to total liabilities, 40, divided by 60. Your debt ratio is equal to 40 over 100. Okay, so this is going to be equal to 2/3. So 66. This is equal to 40%. Um, some people like to think I if you change something here, um, these will both these will both change kind of in the same direction. Okay, I I like to think about this one makes more intuitive sense to me, in my opinion, because it shows what percentage of the assets are financed with liabilities. This one is more stating the ratio between debt to equity. So this could range if you had no liabilities, so zero. It ranges from zero to basically, um, let's see, total equity. It could be infinity, I guess. It goes from zero to infinity. Okay, while the debt ratio ranges from 0 to 100. So I don't know. This ratio, I don't know. I don't really see it used too much. Some people may like like visualizing the split between the two. But it's just in the book, and as long as you know the definition, if you ever saw it, um, you could kind of like let's see, how would I get back if I knew the debt to equity ratio was 66%? You would know that it was 2/3, and you could be like 5 equals 2 plus 3. Yeah. Okay. So look. Okay. So I kind of just did it. Okay. So let's say you had a debt to equity ratio. So I just did the math where debt to equity is equal to 66%, and that's the same as debt ratio of 40%. Okay. So I can get from this to this. How? Well, this is equal to 2/3, which is equal to your liabilities and your equity. And so I can take that information and be like, assets equals liabilities plus equity. Assets equals 2 plus 3. Assets equals 5. And so my debt ratio equals my liabilities, which is this, 2 over 5, which equals 40%. Okay? So they're saying the same things. You can go from one to the other. Okay? I personally think that this is more intuitive, but again, they're related. Okay. But yeah, as long as you can calculate it, and as long as you understand what these ratios are saying, and that they're showing the level of leverage, how much of the balance sheet is using liabilities, that's an important thing to know because it shows how much risk there is. You can see if you looked at a bank, you'll see that their debt ratios are like 10%, like 10x. They have, or sorry, 90%. Okay. Most of their assets are financed with borrowing. Okay. And so they're quite risky. That's why banks always go out of business because they're borrowing a lot. Okay. While there's some companies like software company or Nvidia, they have a very low debt ratio. Okay. Okay. Um, and I guess I just have some uh, sample calculations here. You can see for Adobe, they have total liabilities of this, total equity of this, 1.53 debt to equity. Chevron, oil and gas company, you can see is lower. And then Goldman Sachs, which is an investment bank, has a very high debt to equity. Okay, meaning they have lots of equity, lots of liability compared to equity. That's why it's so high. Okay, but again, you can convert all of these into debt ratios if you wanted to, using kind of what I did here. Okay, okay, and now maybe I'll save this for next week. Okay, let's just maybe take a couple minutes and just work on the practice problems. So let's start back at 208. Okay, so let's take a couple minutes if you want to go to the bathroom. Okay, so in this example, it's a little meta. Okay, it's giving you the information of this bond kind of partway through the year, partway through the life of the bond. It's giving you some information on what happened when the bond was issued, which was 2 years ago. And now it's saying 2 years later, here are the balances. And then ask you a bunch of questions. So if I were you, what I would do is I would figure out what the journal entry was when the bond was issued. Because remember, based on whether it was a discount or premium, every payment subsequent to that, you're like amortizing that initial, whatever happened to that initial issuance is going to be kind of how the balances are, like the starting point for the balances going forward. So 2 years later, you have these balances here, this discount on bond payable. But what is the starting point? You're going to need to know that, because it's going to ask you kind of some questions where you kind of like, what is the carrying amount of the bond? That's kind of easy. The interest expense, you'll have to know how much the per payment amortization is, and you're only going to know that if you go back to the beginning and see what the discount was, and see how many payments there are, and like figure that out. Okay, so try to figure this out, and we'll do it together in a couple minutes. Okay, so in December 25, the bond was basically issued at 85 cents on the dollar. We know that the face value is 700,000. So a simple calculation times 80, so 700,000 times 85%. That's how much cash we actually brought in, 595,000, because it's issued at a pretty steep discount. Okay, 85 cents on the dollar. It's it's a pretty big discount, and therefore your business did not bring in exactly the amount that they're gonna have to pay back. So the answer to this first question, what is the maturity value of the bonds? This is essentially the par value, we've been calling it, or the face value, and it's the amount that we're going to pay back the bondholders, and it's 700,000. Okay, so basically the schedule of payments is, it's a 10-year bond payable 9% coupon, and it's paying semi-annually on June 30th and December 31st. So basically, we can make the whole schedule. So June 2026, December 2026, June 2027, and then let's see if Excel is smart enough to do this. Okay, so this is 10 years, okay? And each payment is going to be face value times coupon rate, 9%, times, or divided, let's just say divided by 2, because it's semi-annual. Okay? And this is going to be the payment of cash. This is how much cash is going to be paid. And then this last one, we're also going to pay off the face value. So ahead of time, I can plot out the entire payment schedule for this bond. based on the coupon, the face value, and the payments, like the maturity date and the payment frequency. So this is a bond, like bond investing is also called fixed income. Why is it called fixed income? Because of this. Is this payment schedule is fixed. Okay. But the problem is that the investors may not be happy with a 9% return. Okay. They may, in this case, definitely wanted a higher return because that's why there's a discount. Okay. So when we first got the bond, we only received 595,000 upfront, and we had to deal with a discount of 700,000. So 700,000 minus this, 105,000. Okay. That is the total amount of discount we're going to have to amortize. How many payments are there? Interest payments. 20, right? Semi-annual, and it's 10 years. This divided by 20. So we know that each payment is going to be, it's going to have some amortization of the discount on bonds payable of $5,250. Okay, so let's just go through this now. What is the carrying amount of the bonds as of December 31st, 2027? Well, it's telling you right here. What is it? What number is the carrying value? This one. It's just the face value minus the contra account balance. Okay. So remember, this is a credit and this is a debit balance. It's just giving it to you in this like balance sheet form, but you should conceptually understand that a bond payable is a liability. That's a credit balance. Discount on bond payable is a contra account. That's a credit. It's a debit balance. And so the net is this credit balance, 616,000. Okay. So the answer to A. Oh, I see what you're saying, Adam. Okay. Yeah. So the face value or the maturity value is 700,000. The carrying amount as of this situation is, you can just do a cell reference to this.
But it's 2 years after the bond was issued, right?
Well, we can already tell that because the discount on the bonds payable is less than what it was when it started. So yes, we've been amortizing this 105. So it is 2 years, and the way we can get that is 2 years is equal to 4 payments. That's how we got that.
So we know that is 2027 in the table.
Yeah. So yes. So these 4 payments have happened, right? Okay. So C, what is the semi-annual cash interest payment on the bonds? Well, we just saw here. What is the cash payment on for every quarterly payment? How much cash is going out? It's just this amount. Again, the investor in the bond is going to receive this series of cash flows. This is like the whole payment schedule. So the amount of cash that they will receive in their pocket is 31,500. Okay. How much interest expense should the company record each year? Okay, so we've now figured out how much the semi-annual cash amount is, and we see what the semi-annual amortization is. Okay, so it might be easier first to do this one. Okay, so let's just see. Let's do this June 30th, 2027 semi-annual interest payment. Okay, so we're looking at this one, June 2027. It's 31,500, just like all of them. We know how much cash is going out. So at least let's fill in the easy part, which is cash, credit, 31,500. Okay. We're going to have interest expense. We don't know exactly what it is yet. And we're going to have discount. Actually, discount on bonds payable. And we actually know this amount too. We just calculated it. It's equal to 5,200, which is the starting discount, which is why we had to figure out what the issuance kind of situation looked like, divided by 20, which is because there's 20 payments. Okay. Sorry, this is a debit. No, it's a credit. Yes. Okay. So our interest expense is the sum of these two. Okay. But it's asking for the yearly. So what do we do? What should we do? Just multiply this by 2. Okay. So that's our yearly interest expense for this bond. And it's more than the cash, right? The amount of cash we're paying out per year is 63,000. The reason is because we're gonna have to pay an extra 105 on the back end, but we're just splitting that extra amount up evenly as an expense over the period, over the bond's life. Okay, so eventually though, we're gonna have to have a big, this 105 is like an extra interest. So you got to just conceptually understand what's going on here. We're getting 595,000 up front because we issue at a discount, but we're paying 700 on the back end. Okay, so hopefully that's clear by now. Okay, any questions on this? No? Okay, good. Okay, so let's do 12-10. In this case, we issued a bond, and we now want to retire the bond a year later. And it's immediately after making the second semi-annual interest payment, so you don't have to worry about doing a partial year amortization calculation because it's just happening right on the same day as the interest payment. But just the journal entry basically for retiring the bonds. Really, that's the main thing. Okay, so you can go through step by step. Let's just take like a couple minutes to do this, and then I'll do it with you. But hopefully by now you have some sense of how to at least start this. So take a couple minutes, see if we can figure it out. Okay. All right. So hopefully you're catching on to this. What is Isabella Company's carrying amount of the bonds payable on the retirement date? Well, first we have to figure out what happened when we issued the bond. So we issued it at 106. So 200,000 times 1.06 means that we collected $212,000 of cash. So we issued at a premium. That means that we would have had cash coming in, 212. We would have had it. So this would have been our debit. Credit to 200,000 for bonds payable because that's the face value. And then we would have had this adjunct account at 12,000, which is a premium. I didn't want to tell you, but hopefully you figured that out. So at issuance, this is these are our balances. Now it's saying that we made 2 semi-annual payments. So the per payment amortization. Okay, so what is it? It's a 5-year bond, and it's making semi-annual interest payments. So per payment, how much was the amortization? This divided by what? 10. 5 years, 2 payments a year. So basically, we had 2 debits here, 1,200. Okay, I don't know why this is so. Okay, so the balance at the time of retirement is the starting balance minus these 2 payments. Okay, so the carrying value is just equal to 200,000 plus. Is it plus or minus? Plus. They're both credit balances. So you're going to add them together. Okay, so the answer to the first question is 209,600. Okay, so whatever, I'll just write it here. We just did the calculation. 209,600. Okay, so how much cash must the company paid to retire the bonds payable. This is a pretty simple calculation. What do I do? What price am I retiring the bonds at? Okay, so we're retiring the bonds at 96 cents on the dollar. What is the basis upon which this 96 is calculated on? Is it this 209,600 times 96? No, what is it? It's the par value, right? So this times 96. So this answer to this is simply 200,000, which is the face value, times 0.96, 192,000. Okay, so now we're pretty much set up to answer this third one. We'll just have to do the journal entry. Okay, I think that the easiest way to answer this is to do the journal entry upon retirement. So we're gonna pay cash, 192,000. We know that we will have to debit bonds payable, 200,000. So bonds payable, 200,000. But we have a gap here. This minus this. We need more credit of 8,000. And we know since it's a credit, it's going to be a gain on retirement of bonds. Okay, so the gain is 8,000. And I just did that. Actually, hold on. I messed something up. What did I mess up?
The amortization.
Exactly. I did not yet close out the amortization. Okay. So I closed the bonds payable, but I still have a balance here. So I also need to debit this, 9,600. Or premium, sorry. Premium on bonds payable. So now now the gain is going to be really, really nice, right? So it's basically this plus this minus this. Okay. Gain on retirement. And conceptually, this makes sense. Why? Because we issued it at a huge premium, right? At the price of 106. And a couple years later, we're retiring it at a discount. So it's like we sold high and we're buying back low. Okay, this is kind of like you can say shorting a stock, right? Bonds were sold to the market at 106, and then you're buying back the position at 96. So you sold it for a much higher price than what you bought it back for. So there's a gain. Okay, makes sense? Okay. Okay, so let's do a quick word on time value of money. I think again, I think when you take 187, there will be like a whole chapter on this, but I think it's so relevant to bonds that I think it's worth mentioning because the whole framework that we just did this bond pricing is based on this. Okay, so um, thought experiment. Would you rather have $90 now or $100 in 6 months? Who would rather have $90 right now? Okay. Why not wait 6 months? What's the problem? Okay. The gain is not big enough. Okay. What if I offered you only $20 now? Then what? How does that change?
In comparison to what?
It's $100. Would you rather have $20 now or $100 in 6 months? You're willing to wait. What is the break-even point where you're indifferent to the two? It's between 90 and 200, right? Or sorry, 90 and 20. Because you'd rather, actually in both, yeah. In the case of 90, you'd rather have 90. In the case of the $20 offer, you'd rather wait and get the 100, right? So your break-even is somewhere in between there. But how do I determine that exactly? Okay. Um, okay, how about this? What if I shorten the time period? So I said $90 now or $100 in 6 hours. You're going to wait, right? So it's not the $100 necessarily. It's not the difference between 90 and 100. It's also the time period that you have to wait, right? So the amount that is offered upfront versus the future, it's the time period you have to wait. What else? What else could be a factor? What if I was like a shady guy and I offered you $20 now or $100 in 6 months? Would you take it then? If I'm like the flakiest guy you know, you still would wait and take the risk? Yeah, you take that money, right? So it also depends on who's offering you this deal, right? So the factors are all we just discussed. It's the dollar amounts, both now and later, and the risk and the time, right? All these things matter. And this framework of time value of money is incorporating all of that into a framework, into an equation. Okay. It could also be used to answer this question. If you won the lottery, do you take $100 or let's say you won $100 million? They offer you two things. They're like, we'll either spread out that 100 million over 20 years in equal installments, or we'll give you 50 million upfront in one shot. What should you take? What is a framework you could use to answer this question? Did you just go with your gut?
No.
Right? There is a framework. There's a mathematical framework that we can use to answer this question definitively. Okay? Yeah.
There is one more variable comes in
Hmm.
because if you don't want to think of money, just get like monthly payments. You would not care like about lump sum at all.
Yeah, you would though, because what if I could take the money and put it into an index fund,
Yes,
right?
you don't want anything
Of course, yeah. Well, this is actually in the framework because there is a term for so again, future value equals present value times 1 plus r to the t power. This r represents many things. It represents risk. It represents opportunity cost. It represents your required rate of return on an investment to make it. So this R kind of, what you mentioned is opportunity cost, right? If your opportunity cost is 0, then if you put 0 here, then this just turns into 1, and present value equals future value. Okay, so it's in the framework. It's how you want to interpret R. Okay, so this mathematical framework can help us answer this question. Okay, and a bond investor is doing this same thing because you've given them a series. You've given your investor a series of cash flows. Year one, $100. Year two, $100. Year three, 1,100. This is just a series of cash flows. Each one of them has a different value. $100 in 1 year has some present value. $100 in 2 years has some present value. $1,011 in 3 years has some present value. And then you add all these up and you'll get the total value of this series of cash flows. And that's what bond pricing is. Okay? So if I show you this spreadsheet, okay? If I just did this calculation using my formula of what is the present value, because look, I can solve for present value because I have the future value, right? This is a future value. This is $1,100 in 3 years. If I want to know what that $1,100 in 3 years is worth to me right now in the present, I have to solve this equation for this term. Okay, so how do I do that? I do future value divided by 1 plus r to the t power. Okay, and in the case of this 1,100, it would be 1,100 divided by 1 plus some discount rate. I'm gonna leave that as a variable over 3. And this discount rate is a yearly discount rate. Okay, so if I did this for this bond, which has these 5 years of cash flow, I will do it like this. This divided by 1 plus, I'm going to use this discount rate, 3%, to the this power. In this case, it's the first year, 1 year. Okay? And actually, let me do one thing. Let me fix this. Okay? And now, if I just apply this downwards, okay? You can see that each of these has a different present value, okay? The present value of the second year, even though it's $300, is a little lower. Why? Because it's taking me a little more time to get that $300. There's opportunity cost, that extra year. So it's worth to me, $300 in 2 years is worth a little less than $300 in 1 year, right? And that makes sense because you're having to wait an extra year for it. And then, of course, after 5 years, even though you're getting 10,300, you're having to wait 5 years. And so the present value of that is $8,884. Now, if I change the discount rate, let's change it to 10, everything drops, okay? Because the discount rate represents risk, it represents opportunity costs, right? So if you had some crazy good investment you can make right now, you're like, dude, I'll take less money right now because my opportunity cost is so high, okay? Or you can think about it as risk, meaning that, well, that $300 in 2 years is risky. So if you offer me a little less money now, I'm willing to take it because I don't want to take the risk. So however you want to interpret discount rate in your mind, it captures many different things. Again, the riskiness. So the more risk something is, the higher the discount rate, meaning the more return you're going to want to make if you're taking a higher risk. Okay. So if you added these up, this is the present value of this entire bond. Let's see that this is the, if I did NPV, and actually this is right here. It's the same as just adding up all these individual cash flows. Okay, so you can use this same framework for also valuing a stock. So I had some fake 5 years of data for a stock. You get to a free cash flow. So what is this? In 5 years, you're expected to collect this amount of cash. What is it worth to me right now? I can use the same framework. The discount rate, you can get a present value of these cash flows divided by the number of shares, and that would give you like a stock valuation. Okay, so this framework is useful in many contexts where you have cash flows that are going into the future and you want to figure out what they're worth right now. Okay, you have an announcement to make.